Hello and welcome to Unacademy, a one-stop destination for all the English medium civil service aspirants. Welcome to another session of Economy Weekly Recap, wherein we take up all the important economy-related articles which appear in different newspapers and analyze these articles. For this week, this is the list of the articles that we'll be analyzing. Now, before I start the discussion, two very important announcements. We at Unacademy will be launching Arambh batch for the English civil service aspirants starting May 31st and a purely English batch, Triumph batch, starting from June 8th. Those who are interested, please give a call on this particular number. We will also be providing you 1:1 mentorship services. Comprehensive study material will be provided. And to get into the civil services, one important area is practicing the preliminary examination as well as for the mains examination. We'll be providing you the test series. And in addition to this, unlimited access to batches will also be provided. Those who are interested, check out the link provided in the description. The second very important announcement is, many of you keep on asking me for the PPT that I use as well as the summation of the articles that I discuss in the session. All you need to do is scan the QR code which is right now visible to all of you. You'll be redirected to a Telegram channel. Join our Telegram channel. The PPT as well as the summation of the articles will be uploaded in the Telegram channel. With this caveat, let me start the discussion. The first important article. After 10 years, S&P Standard & Poor raises India's outlook to positive. What are the important points here? Point number one, you will come across a concept of credit rating. Credit rating. Basically, credit rating refers to the willingness of the borrower to repay the loan. Now, this willingness of the borrower is measured for companies, it is measured for the government, it is measured even for individual borrowers such as you, such as me. In case of individuals, this is generally referred to as a CIBIL score. Whereas in case of companies which are willing to issue instruments in the market, government which is willing to issue instruments in the market, this is referred to as credit rating. And in the context of the government, this is referred to as sovereign credit rating. Now, whenever you talk about sovereign credit rating, we have rating agencies in the domestic market, we have global rating agencies. The three very important global rating agencies are one, S&P, Standard & Poor. Second one is Moody's. And the third one is Fitch Credit Rating Agency. These are the three very important global rating agencies. For a very simple reason, these account for more than 90% of the global credit rating business. Now, these rating agencies, historically, if you look at India's sovereign credit rating, these have provided a sovereign credit rating which is in the range of the lowest investment grade. What is that? We'll come to that. Please do not worry. Whenever you talk about the credit rating, or for that matter, sovereign credit rating, the ratings are provided either in the form of simply alphabets or in the combination of alphabets and numbers. For example, you must have seen credit ratings such as AAA, AA, in the context of India, BBB, or you must have seen a credit rating in the nature of BAA2, BAA3, etc. That is in a nutshell, either purely alphabets or a combination of alphabets and numbers. Now, in case of S&P, understand this, in case of S&P, Standard & Poor, after 10 years, the outlook for India, I repeat, the outlook for India has been changed. The outlook has been raised one notch above or has been changed to positive. Now, what are the important points you need to understand? Whenever you look at the credit rating, it is having, let's say, alphabets. In addition to alphabets, they will use a positive or negative symbol like this. In addition to the symbol, they will also use the terms negative, or they will use the term stable, or they will use the term positive, and in some cases they will also use the term developing. Now please understand these particular terms. This is a credit rating and this is basically outlook. The alphabet along with the symbol, that is positive or negative symbol, it is a credit rating, and these terminologies, it is referred to as outlook. And what is the meaning of the outlook and what is the importance? What does it actually indicate? Whenever a credit rating is provided, let's say triple B, it simply is one type of a credit rating. And the credit rates which are provided are divided into two parts. One is called as an investment grade. If you look at these ratings from AAA to let's say triple B, these are called as investment grade credit rating. And anything below the triple B, let's say such as a C, such as a D, etc., these are called as a junk grade or speculative grade. Junk grade or speculative grade. And basically it means if you move down, if you keep on moving down from the top of the table, from the AAA like this, the risk that is associated will keep on increasing and the coupon rate automatically will also keep on increasing. This is basically the idea of a credit rating. Sir, what does the symbol signify? If plus is written, if minus is written, what is the importance of the symbol? The symbol basically signifies what is this rating within a group of ratings. That is triple B minus, triple B plus. Generally these kinds of, within the group of triple B, what is the standing of the credit rating, that is signified by the symbol. Now come to the outlook. These are the terminologies: negative, stable, positive and developing. What does it generally indicate? For example, in case of India, the outlook has been changed from the stable to positive now. What does it generally mean? Whenever the credit rating outlook is changed, let's say from stable to positive, it generally indicates that in the next 6 months to 24 months, I repeat, in the next 6 months to 24 months, there might be an upgradation of credit rating. The credit rating might be upgraded. That is basically the indicator. The last time the upgrading was done for India's sovereign credit rating was back in the year 2007 by S&P. So in the next 6 months to 24 months, there might be an upgrade. I'm using the term there might be for a very simple reason. S&P no doubt has changed the outlook, but it also has indicated that if government after, let's say, once the government is formed after elections, if the government does not control the fiscal deficit, that is general fiscal deficit, overall fiscal deficit, if it fails to control debt, if it fails to control inflation, etc., then the outlook might be again revised back to stable itself. So argument is simple. Whenever you are given a stable outlook, it simply means there is no change in the credit rating. If you are given a negative outlook, in the next 6 to 24 months, your sovereign credit rating or credit rating might be downgraded. If you are given a positive outlook, you might be upgraded a notch. And if you are given a developing outlook, it simply means there is no way to decide right now. Based on the situations, they will decide what should be done to credit rating. That is basically the credit rating will be decided over a period of time. This is the meaning of the outlook provided here. And in the context of India, S&P says because of certain reforms of Government of India, increased expenditure on infrastructure done by Government of India, it has decided to change the outlook from the stable to positive. And this has been done for the first time by S&P in the last 10 years. So this is basically the discussion related to the concept of credit rating, sovereign credit rating, outlook, etc. Now based on this, I have given an MCQ here. Consider the following statements regarding sovereign credit rating. These are regulated by CCI in India. And when I say these are regulated, the sovereign credit rating agencies, the agencies which will provide, are these regulated by CCI? CCI, by the way, stands for Competition Commission of India. Statement 1 is wrong. The credit rating agencies in India are regulated by SEBI. Please remember. Second one, The agencies, while providing the sovereign credit rating, include quantitative as well as qualitative parameters. Sir, what do you mean by quantitative and qualitative parameters? In fact, last year, in the year 2023, Chief Economic Advisor wrote an essay regarding sovereign credit rating. One of the concerns that was raised in this particular essay was the methodology differs from one rating agency to another rating agency. What are the parameters which are included differs from one agency to another agency. And one more very important criticism was that many of the times these rating agencies, the methods that they follow favor developed countries and are biased against developing countries. For example, interference of the government in the banking sector. When I say interference, presence of government owned banks generally is not preferred by credit rating agencies. They will give lesser marking if the government owned banks are present in the system. And in case of India, a lot of public sector banks are there. And when I say public sector banks, these are majorly owned by Government of India, more than 51% ownership. And if you look at the same situation of banking in Western economies, they are dominated by private sector banks. So obviously in terms of these parameters, Western countries would be performing much better compared to Indian economy. But the viewpoint of the Chief Economic Advisor, which has been accepted by a lot of experts, is that the requirement of the economy in India are different. The role of Government of India in order to promote Indian economy is different compared to what is the role of Government of USA. So in such a situation, how can these kind of parameters can be used to reduce the grading, or let's say to limit the grading for Indian economy compared to, let's say, Western economy? I'll give you one more example. The debt of Government of India. In case of India's government debt, there has been no instance in the past where Government of India has defaulted on a repayment. It has always honored the repayments. Whereas in case of many other countries which have a higher debt compared to India's debt, many of the countries have more than 100% of GDP in the form of a debt. Their credit rating is much higher compared to India's credit rating. So there has been a criticism regarding the methodology which has been followed by the credit rating agencies. But coming to the point here, let's stick to the point. Do they include quantitative as well as qualitative tools, or let's say qualitative parameters in deciding rating? Statement is correct, by the way. Statement is correct. In case of many of these rating agencies, for example, they will measure GDP. It's a quantitative tool. They'll measure governance. It's a qualitative parameter. So both they use qualitative as well as quantitative, and statement 2 is correct. 1 is wrong. So right option will be option B. Only 2 is correct. Let me go to the next article. LTCG liability to ease on cost inflation reset. What are the points here? All of you heard of capital gains tax, CGT, capital gains tax. You purchase an asset, you own the asset for a certain time period, and then you sell the asset. Based on the difference between the price of acquisition, that is the price that you purchased at, and the price at which you sold, there will be a calculation called as a capital gains. On the capital gains, government will impose a tax, collect. That is called as capital gains tax. In case of capital gains tax, there are two types. One is called as short-term capital gains tax, and the other one is called as long-term capital gains tax. And from one asset to another asset class, what is the short-term, what is the long-term will keep on changing. For some of the assets, short-term and long-term is decided based on the holding period of 1 year. In case of some of the assets, holding period changes to 2 years. In the beginning, when this idea was initiated in India, when the concept was introduced in India, holding period was 3 years. Now it has been different. It has been made different for different class of assets. But come to the point now. In case of capital gains tax, imagine you paid 1 lakh rupees. Imagine you paid 1 lakh rupees for a piece of land. You purchased it. And after a couple of years, you will sell it, let's say, at 2 lakh rupees. according to you, generally you will simply come to a conclusion, sir, profit is 1 lakh rupees. You'll say capital gains is 1 lakh rupees. On this the tax would be imposed. But government says, let's say you purchased the land in 2020 and you sold the land in 2025. So there would be inflation in these particular 5 years. Agreed? There would be inflation in these particular 5 years. What is the price or what is the purchasing power of rupee back in 2020 would be much higher compared to purchasing power of the rupee in 2025. So whenever the price of the asset has increased like this, it would be because of inflation rate as well. Is it okay? It could be because of inflation rate as well. Now the argument of the government is, the tax that I want to impose should be on the real appreciation of the value of the asset, not because of the inflation rate. Is it okay? I'll repeat the statement. The government says, whatever tax I want to impose on the capital gains, this capital gains should be on account of real increase in the value of the asset, not because of increased inflation rate. That is the reason, whatever price you have paid when you purchase the land, the asset, you will have to index it. You will have to index it. There is a process called as indexation. Now, how do we index the asset value? How do we change the value of the asset? That's where the cost of inflation index, which is published by CBDT, will be used. Is it okay? CBDT, Central Board of Direct Taxes, publishes an index, and that is called as cost of inflation index. The cost of inflation index is used to index the value of the asset. For example, I'll just give a very simple example here. According to the calculation that we have done earlier, capital gains is 1 lakh. And imagine the capital gains tax is 20%. According to this calculation, you will have to pay a tax of 20,000 rupees. More importantly, many of the students will ask me, sir, what is the land I can purchase by paying 1 lakh rupees? I will not be getting any land in the market. That is not important. Understand the concept of capital gains tax here. How the indexation is done? The base year for the indexation right now is 2001. Earlier it was 1981. We have changed the base year to 2001. That is basically, we will provide certain numbers starting from 2001, using which indexation will be provided. Let's imagine for 2020, for the year 2020, the index number that was provided was a 200, and for 2025, based on the calculation, the index number that was provided was 240. So for 2020, 200, for 2025, 240, which means, can I simply conclude, between 2020 and 2025, index number has increased by 1.2 times. Use the number, change the value of the asset. Index number has increased by 1.2 times, multiply that 1.2 times with 1 lakh rupees. Now you will have 1.2 lakh rupees as adjusted value, indexed value of your asset. You purchased it at 1.2 lakh based on the indexation. You sold it at 2 lakh rupees. Now basically the capital gains will be 80,000 rupees. On this you will pay 20% tax. Do not worry about the calculation. Do not memorize the calculation. UPSC is not going to ask you about calculation. But the important point is how indexation is used. Is it actually based on the value that you will decide the capital gains, or you adjust it for inflation based on which you impose capital gains and collect it? So coming back to the point here, the long-term capital gains tax liability may ease on account of cost of inflation reset. Why are they saying this? The inflation index for the year 24 has been announced. For the year 24 and 25 has been announced. And the inflation index number is 363 for 24 and 25. And for the previous year, that is 23 and 24, it was 348, which basically means the inflation index has risen by around 4%. And please remember this, when the inflation index goes up like this, increases by a larger number like this, automatically the indexed value will be increasing. If the indexed value increases, capital gains would be reducing. And if the capital gains reduces, amount of taxes that you pay to the government will come down. I'll repeat the process again, listen carefully. If indexation number is higher, for example, instead of 1.2, imagine it was 1.4. Just imagine. That is comparing the index number of 2020 and 25. Imagine it was 1.4 times. And if it is 1.4 times, your value will not be 1 lakh rupees now. It will become 1.4 lakh. Compared to earlier 1.2, now it will become 1.4. If it is 1.4, capital gains will not be 80,000. Capital gains will become 60,000. And if the capital gains becomes 60,000, automatically the amount of taxes that you pay at 20% would be lower. So this is a basic idea, and that's exactly what has been given in the headline. Some of you might be thinking, sir, why are you showing all the calculations? Look at the headline of the article. And by the way, this appeared in Hindu newspaper itself. LTCG liability to ease on cost inflation reset. Meaning what? Inflation index has increased. Automatically capital gains will come down. The amount of taxes that you will pay to the government will come down now. This is basically the discussion related to article. I have given an MCQ now. Consider the following statements regarding cost of inflation index. It is used to calculate the long-term capital gains on certain assets. Yes. Now some of you will be asking me, sir, what about short-term capital gains? Is there any indexation? Generally no. Point number 2, many of you will have this kind of a doubt. Sir, in the example that you discussed earlier, there was a capital gains. What if instead of capital gains, if there's a capital loss? Then under the taxation law, you're allowed to carry forward these particular losses and set off in certain instances. That will be done by your chartered accountant, you do not worry. So first statement is correct. With the tax rate being the same, with higher cost of inflation index, with higher CII, the tax collected would be higher. No. With higher CII, the tax collected would start coming down, not increase. So first statement is correct. Second statement is wrong. Right option for the question will be option A, only one is correct. Let me go to the next article. NSE lowers the tick size to 1 paisa for selected the scripts as such. Now what is this tick size? Understand this carefully. The tick size essentially means, imagine right now a particular share is listed at 200 rupees. A share is listed at 200 rupees. Now if you want to purchase the share, if the price of the share increases from 200 rupees, it doesn't abruptly suddenly change to some other price. It has to change by the same tick size, which means, imagine the tick size is 1 rupee. Imagine the tick size is 1 rupee, which now means from 200 rupees, the next price at which the market price of the share will change is 201 rupee. You want to purchase it? The next price that you will have to pay is 201. Sir, what if after 201, which price will be paid or which price will be quoted? The next price will be 202 rupees, assuming the tick size is 1 rupee. Essentially, the tick size is by how much price, by how many rupees or paisas, the next price of the scrip will be quoted. The next price or the lower price, by how much paisas or rupees it will change. That is called as a tick size. The Bombay Stock Exchange, understand this, the BSEs, Bombay Stock Exchange already has done the tick size, that is has already changed the tick size to 1 paise. It has already changed the tick size to 1 paise. Now this has been announced by the National Stock Exchange. National Stock Exchange. Even NSE has changed the tick size from 5 paise. From the 5 paisa, now the tick size has been changed to 1 paisa. 1 paisa, not 1 rupee, 1 paisa. Now some of you might be thinking, sir, what is the use of it? If they change the tick size, what will be the importance of it? Importance is very simple. When the NSE or BSE changes the tick size and it is lowered like this, it is expected to increase the liquidity of the assets. It is expected to further increase the liquidity of these instruments in the market. Reason being, imagine you want to purchase these particular scripts. Earlier your concern was, if I want to purchase a script like this, the next tick size is, let's say, 1 rupee or 5 rupee. And if you want to purchase in bulk quantity, the amount of money that you will have to pay would be higher. That is, compared to 1 paisa tick size, 5 paisa tick size, the amount of money that you will have to pay when you purchase 100 shares would be very high amount. Now, instead of 5 paisa, if it is 1 paisa, don't you think lot of the investors will start purchasing these instruments? The demand for these scrips would start increasing. It will promote higher liquidity of these instruments. Point number 1. Point number 2, this will also promote better price discovery. This is also expected to promote better price discovery for these instruments. People, that is investors, such as institutional investors, retail investors such as you and me, because the tick size is lower, that is 1 paisa now. Higher demand means better price discovery for these instruments in the market. That is the second important outcome that is expected by lowering the tick size. Third one, it is also expected that with better or lower tick sizes, many of these, let's say, the investors in the market, institutional investors, they can have a better portfolio. They can package different products now, different securities, and sell them in the market. So these are some of the important outcomes that is expected with lowering of the tick size by National Stock Exchange. Now, based on this, I have given an MCQ. Consider the following statements. The tick size is the same in case of NSE and BSE. Yes, both have a tick size of 1 paisa now. Lower the tick size, more will be the liquidity. Absolutely correct. Lower the tick size, more will be the volume of securities traded. This is also true, because the lower tick size will attract lot of investors. All the 3 statements are correct. Right option for this will be all the 3, or only 3. Right option is option C now. Let me go to the next article. India's farm input subsidies spiked to $48 billion in 22 and 23. And this sudden rise in the farm subsidies has attracted lot of criticism, lot of discussion within the WTO and from the members such as Brazil, USA, etc. Now let's understand. Under Agreement on Agriculture, AOA, under Agreement on Agriculture, different countries are allowed to provide trade distorting subsidies. Trade distorting as well as least trade distorting or negligible trade distorting or non-trade distorting subsidies are allowed to be provided under a pillar under the Agreement on Agriculture, which is called as domestic support. Domestic support. And in case of domestic support, a developed country is allowed to provide 5% of value of production in terms of aggregate measure of support to agriculture, and developing countries are allowed to provide 10% of value of production in the form of aggregate measure of support. But in case of developing countries, please understand, in addition to a higher limit being provided, there is also a concept of special and differentiated treatment. S and DT, special and differentiated treatment. That is, in case of developing countries, if these developing countries provide certain subsidies for rural growth, development of rural part of India, agriculture sector, etc., certain exemption is provided for these subsidies. That is, let's imagine, Government of India will provide certain subsidies in the form of inputs, in the form of fertilizer, in the form of irrigation to very, very poor farmers. Very, very poor farmers. That is, let's say, marginal farmers. Then automatically this will be counted as a part of special and differential treatment. That is under the WTO Agriculture, Agreement on Agriculture, there is also a box called as development box. Whenever the developing countries provide subsidies for rural growth, agriculture, development, etc., there are further exceptions provided for such subsidies. So coming to the point now, Government of India has provided lot of subsidies, and the amount of subsidies under Agreement on Agriculture, that is under the domestic support, previous year 22-23, that is previous year to 22 and 23 was $32 billion, and suddenly in 22 and 23 it has ballooned, it has jumped to $48 billion. So USA is criticizing India and many other countries, including USA, they are demanding that, one, the government of India should become much more transparent in providing the information. Second, USA is saying, if my trade distorting subsidies are X rupees, India's trade distorting subsidies are more than twice the amount of that. Their contention is India is providing twice the amount of subsidies which are provided by government of USA. That is one more criticism. But government of India on the other side, it is saying these particular arguments in favor in defending such a policy. Point number one, under WTO, whenever the member countries will provide these kind of subsidies, they have to disclose the information. And India says, I have disclosed all the information on timely basis. I have disclosed all the information that I am supposed to submit on timely basis. Second one, the rise in the subsidy that you are looking at, the rise from 32 billion to 48 billion is account of inflation rate. Is on account of inflation rate. Inflation rate has dragged up the market prices of the commodities. I am forced to provide more subsidies. Third reason, rise in the fertilizer prices. Rise in the fertilizer prices also has accounted for higher amount of subsidy that I am forced to pay. And the fourth point is, under agreement on agriculture, I am allowed to provide these kind of subsidies. Why? Majority of the farming households which are present in India, more than 90% of them, are marginal farming. That is, they earn very small amount of income. And because these are earning very small amount of income, I am going to provide more amount of support, and because of that, the subsidy bill for government of India has ballooned from 32 billion to 48 billion. So these are certain very important points associated with the article provided here. But in addition to this, there is also one more point which is being discussed. That is, many of the countries are in favor of restructuring the provisions under agreement on agriculture. They want restructuring. They want revamp of the provisions under agreement on agriculture. Government of India is opposed to it, because the government of India is concerned that developing countries might use this situation, try to control, try to basically minimize the amount of subsidies. By having a different calculation, our subsidies might be minimized. That is the concern. In fact, government of India, along with many other developing countries, we are demanding that the exception that is provided for developed countries, because mind you, although under agreement on agriculture, 5% is the limit. But beyond that also, in certain circumstances, developed countries are allowed to cross that particular 5% limit. Additional subsidies are provided, exemption is provided. Government of India wants this particular exemption to be removed. They want, that is, Indian government wants developed countries to stick to just 5% of aggregate measure of support, or 5% of value of production in the form of aggregate measure of support. This is basically the discussion which is happening in the article. Let me go to the next article. RBI to boost use of rupee overseas. In the last couple of years, I'm pretty sure you must have heard of the term called as internationalization of rupee. Internationalization of rupee. And continuing the promotion of internationalization of rupee, RBI now is expected. It is expected that RBI will allow rupee accounts to be opened outside India as well. Now, what is the concept? What is the meaning of all of this? Point number one, internationalization of rupees simply means right now Indian rupees are used within India for conducting trade, for conducting transactions, buying and selling, etc. But with internationalization of rupee, rupees will not only be used in India, but also will be promoted for conducting transactions outside India. Just like today, dollar is used across the globe in many countries apart from USA for conducting trade, for settling transactions, etc. We want the rupee also to be used in the foreign markets. That is basically the idea of an internationalization of rupee. And to promote internationalization of rupee, already various reforms have been undertaken by both Government of India as well as the Reserve Bank of India. Continuing these particular reforms, now it is expected that RBI will allow, just reiteration of the earlier point, opening of rupee accounts in the overseas market. What is the meaning of it? Right now, if you open a bank account, you are a resident of India, citizen of India. If you open a bank account, if you deposit any money, if you withdraw any money, that is done in rupee terms. But if you are a citizen of USA, it is done in dollar terms. But what RBI is now proposing is that rupee bank accounts will be allowed to be opened outside India. And what is the benefit of this? Imagine you are a citizen of USA now. You are a resident of USA. But you hail from India. You basically are from India. Now you are a resident residing in USA. You open a bank account with an Indian bank outside India, that is in USA. That bank account will be denominated in rupees. You can borrow money from Indian bank. You can deposit money that is in rupees into this particular bank, which basically means rupee usage is being promoted outside India in USA in this example. And that is basically promotion of internationalization. That is a reform to promote rupee in the global market, internationalization of rupee. So this is what is being proposed by Reserve Bank of India. What will be the modality? In which countries we are going to allow this to open? Over a period of time, RBI will come out with the proposal. We will have a discussion regarding this whenever such proposal is put forward by RBI. Next article, the last article for this discussion, RBI unveils Pravah portal for approvals. In fact, although only the headline says Pravah portal, please understand, RBI announced three very important reforms. Very recently, three very important reforms. The first one is RBI has announced unveiling of or launch of Pravah portal. Second one is retail direct gilt. Retail direct gilt app has been launched. Retail direct gilt app has been launched. That's the second one. Third one is basically regarding the fintechs. The third one is regarding the fintechs, portal for fintech. Now, the first two are very, very important. That is Pravah as well as a retail direct gilt app. What is this Pravah? Please understand. In case of a Pravah, RBI says many of the applicants will have to apply to get approvals from RBI. There are more than 60 types of approvals that you need to apply from RBI now. For example, under FEMA, Foreign Exchange Management Act. Under FEMA, if you want to apply to RBI, generally the application goes through a bank, because bank is a middleman, authorized dealer now. A bank will take up the application. They will have their own internal mechanism, and then they will send this to Reserve Bank of India. RBI will give the approval. RBI simply says, in most of these cases, the system will change from one bank to another bank. And because the bank is present, there is one more layer, where there is one more intermediary being introduced now, and that will further increase the time taken for getting approvals. RBI now says all of that will not be required. If you want certain approvals, more than 60 approvals, you can directly apply using the portal, that is Pravah portal. And what would be the use of it? You are directly giving an application to RBI, point number one. Point number two, it is expected to reduce the time that is consumed to provide approval. Third one, you will apply for the approval. You can keep a track of your approval. You can check the status, whether the approval is provided or not. That is the importance of Pravah portal. First one. Second one, Retail Direct Gilt app, RDG app. What is this Retail Direct Gilt? It is basically a type of account under a scheme that you open with Reserve Bank of India. That is retail investors, by the way. You can open an account with RBI, link that account with your bank account, and using this account you can directly purchase government securities whenever these are sold or auctioned by RBI. That is the use of the Retail Direct Gilt scheme. Now RBI says, along with the scheme, I am also going to launch an app. You can use the app to do the same transactions, that is a Retail Direct Gilt app. And the third one is a repository for the fintech. A repository for the fintech, basically a database for the financial technology companies. So these are the three very important announcements done by RBI very, very recently. Now these are the various important articles as well as the questions related to articles. Before I wind up the discussion, one more very important announcement. I'm pretty sure a lot of you are waiting to appear for the civil services examination, and many of you are nervous about it. You are worried, you are concerned as to whether you are sufficiently prepared or there is a need for further preparation. To evaluate yourself, we will be having a All India mock test on the 9th of June. Please attend this particular examination. Attend the live discussion also on the next day, which will be conducted by experts on this very same channel. And ensure that whatever mistakes you are making, these will be resolved. Whatever are the areas which require a quick revision, you will be able to come to know. So please do not miss this particular test. Registration is free of a cost. Please do attend the test as well as the live discussion on the next day. So that's it from my side. See you again next week, where we will discuss a couple of more important articles which have appeared in different newspapers. If you are yet to subscribe to our channel, kindly do it now. Thank you.